You're listening to the Option Alpha podcast from optionalpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at optionalpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from optionalpha.com, working every single week to make this the most popular investing podcast offered in iTunes and online because it's based on one thing and one thing only, and that's helping you make smarter trades. So thanks so much again for tuning in today, and we're at show number 50, which is actually pretty insane. So I just want to say wow, and thank you so much. I've gotten a lot of amazing feedback. I'm so glad that I started this podcast almost 20 months ago. You know, some people out there, some marketers and some podcasts, they take 2 months to get to 50 shows. It's taken us 20 months, but that's okay because I never want to release a podcast, and I've never been doing this to release a podcast just for the sake of putting crap out there. So I want to make sure it's insanely useful to you, or I'm not going to talk about it. And that will continue to be my promise going forward for hopefully the next 50 episodes and many, many more after that. But I truly enjoyed doing it. We've got about just over 250,000 downloads now on the show, which is pretty insane when you actually think about it. It's a little over 425 people per day that are starting to listen to the show. And that's just starting to grow exponentially here. A lot of those downloads have actually come in the last 4 and 5 months. So as we get a little bit more consistent with the show schedule here and, continuing to put out more research and content, I just encourage you, if you like the show, again, the best way you can support us is heading on over to iTunes and leaving us a review or a rating. Absolutely the best thing that you can do for us to get us in front of other people who are just like you. Now, I want to talk about today, obviously, this conversation, debate about stock market being random. Is it predictable? Is it not? Is it random walk, efficient market hypothesis? We're going to talk about all that stuff in this episode. It may run a little bit longer as we kind of, talk through this conversation, but I want to let you know that I deliberately lined up this show as I was kind of scheduling out the shows I was doing to follow show 49, which was the last one that we did, on how to profit from a stock market crash. Not because I think that the stock market may crash or may not crash, but I actually got a lot of emails from people after we released show 49 with people asking me, hey Kirk, did you change your tune on buying options? Do you think, buying options is profitable? And all the different variations of that. And the reality is that I'm not ever going to suggest, nor will you even hear me in show 49, suggest that buying options is the best route for you to go, because I think option selling is more profitable. And we've proved this in, studies, and we're proving it in backtesting. It's proven, through implied volatility and math formulas. But the key here is that you actually recognize the impact that timing has on just one particular case study. And again, in show 49, if you haven't listened to it, go back and listen to about how you can profit off a stock market crash. But timing is so important. So that's why we're going to talk about today, stock market randomness or predictability. Now, if you actually go back into show 49, we had looked at in that show, in that backtesting kind of analysis with those 15 different strategies, just 2 years, 2007 and 2008, assuming that you were 100% right in calling the market crash. Now, if you actually expanded out that timeline to 3 years, so 1 year on either end, so 2006 through 7 and 8, or if you did 2007, 8, and 9, because maybe you didn't think the market crash was done. So if you expanded out that backtest 1 year on either end to 3 years, then in each and every scenario that we backtested where you're buying options, you lost money. And that's pretty powerful because it just shows you the impact that timing has on your ability to make money, especially buying options, not necessarily selling them. In fact, when you actually dig a little bit deeper, and this is stuff I didn't want to talk about then, but do want to talk about now because it kind of relates to what we're talking about in market randomness here. When you actually dig a little bit deeper into when those put buying strategies made money back in show 49, the fact is that they really only made money in 2 months out of the 24 months. In 2007, for all of those strategies, you lost on average of 57% of your capital waiting for the crash to happen. Now, again, that was assuming that you actually knew it was going to happen in 2008 and you kind of had to hold through it in 2007. You still made some pretty good money, but the reality is that how many of you would actually have held through a 56% drawdown in your capital? Probably nobody would. I don't know if, maybe I would even hold through that and kind of, stay on bar and stay consistent with, put buying, right? But that's the reality, is that it is so incredibly hard to time things. And even if you get it right, you may have to hold through a significant drawdown in that process, kind of waiting for that, predictable thing to happen. So my goal on today's show is 100% simply to present the research to you, talk through some of the things that we're going to be, discussing, some of the articles and research or papers that we're going to talk about here, and really challenge you to ask yourself some serious questions about investing in the stock market. Questions like, is the stock market random? If it is, should we care about direction? If it isn't, can I even uncover these random, non-random patterns? Like, how do I find them? And if it's not random, where do I look to get this? How much time or money would it take to, profit under the assumption of either randomness or non-randomness, right? Like, if you think the market's random, how much time and money do you think it's going to take to profit from that? If you think it's not random, what do you have to do in that situation so that you can profit from the non-randomness of the market? And basically, the big question is like, what strategies fit your trading style best? And I think when people ask this to themselves, they naturally sometimes gravitate toward whatever they assume that they want to trade. So a lot of people come and they say, I want to be a day trader. And then we start digging through and they find out they really don't want to be a day trader. They just don't want to have money invested that long. It doesn't necessarily mean they have to be a day trader. So it's asking those kind of really serious questions, as we go through this, what I call like the final debate on efficient markets. So as we go through this here, like I said, there are so many studies out there. There's no way I could have covered them all. So I know inevitably there are going to be people who have other ideas and research and things they want to add. If you do, please head on over to the show notes page, optionalpha.com/show50. Again, that's just the number 50, optionalpha.com/show50. Add your comments, add your links. This is only just a select few of what I believe are kind of like the prominent research and studies out there that we'll link up in the show notes page and then we'll talk about here that I think really kind of prove the case of what we're going to be discussing. But if you have other ideas or opinions or you've done research yourself, I'd love for you to share it on there and kind of help the community here, because there's, in my opinion, as we go to here in the end, I think there's definitely an answer to the question, but I think there's a lot of gray area around that with the markets. Okay. So the first thing that we have to talk about as we kind of get into really the first three topics, which is, time series, efficient market hypothesis, and random walk theory. Because when you talk about markets being random, those are really the things that come up. I think the first one's pretty easy to get out of the way, and that's this time series, hypothesis or theory. And that's the reality is that everybody in the market has more or less a different timeline that they're trading on. So you have day traders, you have people even trading on minute charts and 5-minute charts. Some people trading strictly days, so buy on Monday, sell on Tuesday. You've got weekly traders, you've got monthly position traders and quarterly traders, yearly traders, and then you've got decade traders, etc. So everybody out there is trading on different timelines. So whenever somebody buys in, it's not that everybody at that moment believes that the price will go up from that moment. You might have somebody who buys in that they are just looking for the price to be higher in 10 years, right? Versus somebody who might buy in and they're looking for the price to be higher in 2 minutes. So this idea that there's a time series lag or delay or overlap in the market really adds to the idea that the market is more or less random when it gets down to kind of like the brass tacks of things. Now, the next thing that we talk about then is random market theory. Now, random market theory or the random walk theory, whatever you want to call it, is just the idea that the stock price changes have the same distribution and are independent of each other. So that basically what that means is that yesterday's movement or yesterday's trend in the stock price, whether it was heading higher or heading lower, whatever the case is, doesn't really predict or cannot be used to predict its future movement tomorrow. So yesterday's move was completely independent of tomorrow's move. Okay, and that's the first part of this whole theory and hypothesis on a random market or a random walk. Now, within that is embedded the efficient market hypothesis, which is EMH. And basically, this is the main facet of random walk that really, kind of props up this idea that all information is already priced into the security or the stock price. So anything that's known about the company or anything that's assumed really, because that's really what it ends up being, is already priced into the security. That's why people always will say a common quote is, buy the rumor, sell the news, right? If somebody assumes that maybe Apple Computers is coming out with an amazing new computer and whatever the case is, and their sales are going to grow, well, if that news has already hit you, likely somebody else has already taken advantage of it or has already priced that into the security. So there's no real edge that can be gained when you get news. As soon as news is, is released to the market, it's disseminated, and the news reprices the value of the stock. That's why you see like a classic example. This comes from my days in M&A. M&A was a division in investment banking where you're on the private side of the Chinese wall. So you can't disclose anything, and then you have a disclosure of a merger, disclosure of a distribution of a company or a breakup or whatever the case is. Once that news hits the market, prices react immediately. That's why you see like if a company gets bought out, the price may go from $25 to $50 because now that new news has hit the market immediately and you get this big jump in the stock price. So efficient market hypothesis or theory just basically means that all the news that's out there is really going to price in the value of the securities, good, bad, or indifferent. So that doesn't mean that it's perfectly priced, and that's, I think, maybe a misconception. Doesn't mean that it's perfectly priced. It just means that the expectation of the masses is priced into the security, and maybe even the expectation that that information might be wrong or that people might take the other side of that trade. So when we actually look at these two things here together, one of the charts that we're going to throw up on the show notes page at optionalpha.com/50 is a chart of the daily moves and distributions of the Dow Jones since 1990. Now, this is a chart that I've used in multiple presentations and multiple video tutorials, and I reference it often because I think it does prove the point more or less that the markets do have a normal random distribution. Now, of course, there's some positive skew in the market, and there should be because the market should make more than the risk-free rate of return on average each year, right? That if you're taking risk by investing in the market, you should return on average a little bit more than risk-free, which is like treasury bonds. But the reality is that when you look at this distribution of price movements, there's almost an equal number of days where the Dow Jones moved up 1 or 2% as there is when the Dow Jones moved down 1 or 2%. And so when you look at that chart, you can't help but come to the realization that normal distributions over a long period of time happen in the market. Now, again, this doesn't mean that the market can't, move higher over that time period. It's just like all the noise in between there, the actual daily movements in between there are generally normally distributed, meaning that you're not going to have an abnormally large number of 5% moves without having an abnormally large number of 5% down moves, right? And that's really kind of what we're trying to prove here in this chart. So again, you can check that out on the show notes page at optionalpha.com/show50. Now, something that people always ask, and I get this a lot actually in email from people, then they say, well, if charts are random and, or if the markets are random, then how can guys like Peter Brandt, for example, he's a classic chartist, been in the markets for 40 plus years. How can guys like him make money from charting? Because if the markets are random, then how does somebody like that become so successful in charting and make money from charting? And I find it ironic that people do this because they look at just the outside picture, the fact that, Peter says publicly on his blog that he's a big time chartist. He's a classical chartist, somebody I'd love to get on the podcast. So you can tweet it in for me and help me get him on the show and talk about this. But he said in multiple interviews that he gets almost no edge in his trading from charting. Now listen to this. This is the guy that is probably one of the foremost traders and most successful people trading using classical charting. But he says publicly, quote, I get almost no edge from charting. And it's just what he uses for his signals because, again, quote, he has to use something, right? Now, when you dig a little bit deeper into somebody like Peter, and just because I've, dug research and I know a lot of traders and research a lot of traders, he said multiple times his key is not necessarily charting. It's risk management, position sizing, longevity, consistency, not blowing up your account. It's in recognizing really what you don't know. So the reality is that he probably is one of those people who would say to you, if you asked him, is the market random? He'd say, yeah, more or less the market's random. Are there times where the market, maybe experiences a little bit of a pattern or something that he can exploit? Maybe, but that's not where he gets most of his edge. He's actually just really good at risk management, position sizing, and order entry. And that's really, at the end of the day, what all of us should be really good at as well. So as we get deeper now and kind of cover those basics, time series, efficient market hypothesis, the random walk theory, there's basically 3 big papers or research papers that I linked up in the show notes page that I kind of want to talk about in general. Okay, so I'm not going to dig through and read through them. I'm not going to bore you with that, but there are 3 major research papers that I'll link up there. One is from Malkin, which is the first guy to actually publish what I think is probably one of the biggest books in the investing space, which was The Random Walk on Wall Street, first published in 1973. He then later updated some of his research and some of his thought process in 2007 when he published a report for Princeton. So this is something that you can definitely check out, and I would encourage you to do it because you can see his kind of thought process evolve from the 70s to the 2000s, obviously. And then there's also two other reports in there on random walk theory and kind of, doing a little bit more research in that. Another one from MIT, another one from Chicago Booth, both of those of which I think are really, really good. Very, very long, all of these. I've read them all and kind of trying to summarize here what I think are the most important aspects of that in regard to market randomness. So the reality is, and I think I want to start with this, is that all of these papers really just basically mention a couple things. One, that there have been studies that suggest, namely, there was a mean reversion study that was done by Lowe and McKinley in 1999 that basically suggested that short-run stock correlations are not zero. And what that basically means is that the short-run price movement of a stock is not completely independent of each individual day, right? So this theory or this market hypothesis that yesterday's move has no impact whatsoever on tomorrow's move actually doesn't turn out to be that true. Now, what they said is that there's not this high correlation either, right? It's just not zero. So it's not effectively random on a short-term basis, meaning that yesterday's move in Alibaba, for example, could definitely affect today's move. And I think that we all know that that's probably true. If you hear that stock is down 10% today, what are you going to do tomorrow? It's not like you're going to buy it back up 10%, right? So maybe you sell off some of your shares, or some of that information starts getting disseminated across the market. And they kind of prove this through a study, and you can go in there and look at it. But they also propose that short-run stock prices can gain momentum due to investors jumping on the bandwagon, and they see several consecutive periods of the same direction of price movement. But they also note that on the long run, they do see correlations that are much, much closer to zero, if not at zero, for major markets. So what does this mean? This means that short term, on whatever short-term window you want to describe that as being, maybe a couple weeks to a couple months, you can see price movement start to trend or gain momentum in either direction. And on the longer scale, that is more or less averaged out. And that's really what it comes down to. Actually, Robert Shiller, who's one of the guys that I think he won a Nobel for this. I'm pretty sure they won a Nobel for this on their study of market efficiency and market randomness. Also, a guy that developed a real estate index for the housing index, believes that, really this is one of the things that kind of led to a lot of dot-com booms and a lot of market crashes. Because if you think about it, people jump on the bandwagon with buying up a lot of stocks, maybe housing stocks in 2006, 2007, in dot-com 99 and 2000, bought up a lot of dot-com stocks. This is definitely something that we can see kind of logically playing out in the market. But again, over time, a lot of this noise is just averaged out, and it's been, again, proven through a lot of these publications. Now, one of the things that I find interesting actually in the next, or specifically in the Malkin paper that he wrote for Princeton, is he said a couple things about basically the psychology factors of different influences in security prices, but basically suggesting that Benjamin Graham back in 1967, when he was quoted as saying the stock market in the short run may be a voting mechanism, but in the long run it's a weighing mechanism, and that the reality is that true value always wins out. And so what I think is important about this particular aspect of market randomness and market efficiency is that, again, just realizing that short term, yes, there may be, I don't want to say inefficiencies, but there may be momentum or bandwagoning in one direction or another. And maybe by people just, casting their vote, as Benjamin Graham would say. But in the long run, things always weigh out, meaning that they always either get averaged out so that you're not taking on some easy amount of risk, because if it's very, very easy right now to, buy stock in Apple and trade it higher, then everybody would be doing it, right? And everyone would, jump in there, and then that ability to make money in Apple stock would be greatly diminished by more market participants, right? So this idea that long run, everything is going to weigh out, and some companies or, indices or sectors or countries that need to be there, that have value, will probably play out in the long term. Now, again, you got to get back to asking the question, do you want to play that out in the long term and see if that works, right? And if you're that type of person, you're probably not listening to the podcast that's a fundamental investor that wants to really dig into a lot of these numbers and, buy something and wait 10 years to see if it really worked. I know I don't want to do that myself, right? So that's a question you've got to ask yourself that question all the time. And also, Malkin had said that there does seem to be some momentum in short-term stock price runs. And again, any patterns or anomalies therefore, are basically not really reliable, but are more reliable than random during the shorter periods of time, but become less and less reliable over longer periods of time. Because the reality is that they just don't form the same way over time in the exact same manner that they did before. So things like predictable patterns that maybe you discovered that were simply a result of, looking at charts and kind of trying to fit something into a chart. And I see this a lot with new traders. They try to, draw trend lines where they think a trend line is, but there's a million ways that you can draw that out there on the charts. I think that some patterns obviously could be more reliable than not. And this term momentum keeps coming up a lot in all these research reports. You just have to realize that it's only on a short-term basis or a shorter-term basis, not necessarily a day, maybe a couple weeks or a couple months, but that long-term, the markets do normalize and become more or less random. So one of the last things that you have to realize about all of this stuff, and this is actually a big bone of contention that I have, something that we actually addressed in our signals report, which was our technical analysis backtesting report, is this idea of data mining. And the concept around data mining is that if you churn data enough, you're going to find predictive patterns somewhere. And I think people often find this, and I know when I was doing research, even for this podcast, I came across a ton of articles of people who had pointed out very small segments of time that said, look, this period of time was very predictable, or this period of time was very predictable, or this indicator always works in this one market. And I think the reality is that if you data mine so much market data, and if you really look at everything out there, you will always find some sort of small pattern that presents itself. You will always find some anomaly or some exception to the rule. It happens in life. It happens in everything. There's always people who are faster than everybody else. There's always basketball players who are better than everybody else. And they're the exception to the rule of the average basketball player, the average runner. And so you just have to realize and recognize that that's part of the system out there. I'm proud to say that we actually pointed this out when we did our own research report in Signals, because we actually found that when we backtested a portfolio that allocated 25%, just to see what a portfolio allocating 25% would do, that ended up being the best performing portfolio among everything. But we went back and said, look, even though that's actually the best performing portfolio, we think you got really lucky in just a random string of good trades at the beginning. And therefore that carried you through to the end with this kind of model portfolio that we had built out in the Signals report. We thought you got really lucky allocating 25%. It should be more around the area of 5%, right? Which is what we talk about anyway in most of the allocation videos and risk management videos that we do here on Option Alpha. So it's this idea of recognizing this data mining and the ability that you could randomly get a pattern by looking at some of this stuff that's out there. So the reality is that these things are out there. I think when it comes down to market randomness, without a doubt, in my mind, the answer is that the markets are more or less random. That if you had to pick, the markets are random. Do patterns evolve? And are there areas or instances where maybe you can gain an edge directionally trading something or can discover momentum in something? Yes, but 95% of the market is random in nature. And the longer you stay in this business, which hopefully if you're listening to this podcast, maybe even if you've listened to all 50 podcasts that we've done here, the reality is that I'm in this business for a long time. I've been in this business for 8 years, and I want to be in this business for a long time. So when I actually think about market randomness, I'm not too concerned with the day-to-day movements or the week-to-week or month-to-month movements, because I know long-term, which is when I want to be in this business, in 20 years or 30 years, I still want to be in this business. Then I know that over time, all of this stuff is going to average out or random out. That doesn't mean, again, that there aren't things that could work, right? And I want to kind of really finalize this debate here. That doesn't mean that there are things that can't work, like technical analysis in some cases. I think what's actually really cool for me, once I did a lot of research into this over the last week and a half, kind of preparing for this podcast, is that what we found and what a lot of other prominent people found, like McKinley and like Mulkey, what they found too is that these shorter term momentum indicators and kind of what they called bandwagon indicators do actually have some predictive power. This kind of echoes what we had found in our own independent research with the Signals report, where we found that basically 95% of technical analysis indicators and variations of that out there are basically worthless, have no predictive power over randomly buying or selling stock. But there were some that did have some predictable power. And mainly they were some of the momentum indicators. So of course, if you want to see that, go ahead and check out our signals report, optionalpha.com/signals, and you can take a look. So this kind of echoes what a lot of the stuff that's out there is finding. So does technical analysis work? Yes, in maybe a very, very small instance, in a very small contained set of parameters. Is the market 100% efficient and random? No, it's definitely more random than not, but there are inefficiencies and non-random aspects to the market that we all have to be aware of. Again, the question I want you to ask yourself is, why do you really care, one way or another? I mean, if you do care that the markets are not random, how can you really exploit that opportunity? Because the markets are more random than not. So how much money and effort and time is it going to take for you to find those non-random activities? And if you find one, is it going to be there the next time? And so when I think about, my own trading and how I want to approach the markets, I definitely approach the markets with the thought process that they are random, efficient, not predictable in any way, shape, or form. Not that they are 100%, like I've mentioned a couple times on this podcast, but I approach the markets that way so that I maintain as much of a neutral bias in my portfolio as possible. I don't want to be in the business of predicting where a stock is going to go. I want to be in the business of selling options around a defined range and forcing the market to move outside of that defined range. And that's why I like options so much, because I don't have to make this decision all the time. I don't have to walk this tight line in my head between market randomness and market non-randomness. And so I encourage you, hopefully in this show, at the end here, to really challenge yourself in your own thought process as to where you think it is. And if it's even worth fighting this battle of finding those non-random events in the market, when clearly a lot of the evidence stacks up in the case of the markets being pretty random and efficient.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so before we get into the closing bell, I hope you guys enjoyed that little segment on market efficiency and market randomness. I think it was really, really interesting to do the research myself, and even going through some of these research reports from these Ivy League institutions and very, very prominent people, Nobel Prize winning people. I think that you have to go through it yourself and kind of dig through it. So again, I'll link up all the stuff here. It's all free content that's available out there. I'll have the links in the show notes page at optionalpha.com/show50. Do your own reading, do your own research. Like I said, we couldn't get to everything in here, so I know there's going to be topics that get brought up, and that's cool. We can do that in the comment section and keep this dialogue going about market randomness or market non-randomness. I think it's going to be an insanely useful topic for many, many years to come, but hopefully this kind of really puts the nail in the coffin with a lot of empirical research and evidence behind the idea that just basically the markets are more random than not. So in today's closing bell segment, what I want to do is I actually want to look at a possible trade in DIA, which of course is the Dow Jones Industrial ETF. I think it's fitting because we also talked about DIA. It also came up on our watch list as having one of the stocks with really, really low implied volatility rank right now, which is very unusual for the market, especially for the Dow to have implied volatility this low. But Ivy is ranking in the second percentile, which is about as low as it's been in the last year and a half. And as the markets, at least right now at the time that we're doing this video, start to move higher, we're going to take the opposite position here naturally and take the market randomness or market contrarian position and assume that maybe sometime in the next month and a half, we get a downward move in the Dow. So right now we're looking at the Dow around, or DIA, right around 180. That's where it's trading at right now. And so with front month expirations, this is going to be a little bit tricky doing this put calendar because we're coming up to June expiration. June has about 10 days to go until expiration, at least at the time that we're doing this video. The July contracts have 38 days. You would typically do a calendar spread between the front month, which is June, and the back month, which is July. If we did a calendar spread during that time period, the front month contracts only have 10 days to go. So we're really taking a risky bet, in my opinion, by trading so close to June expiration. With only 10 days to go, and that includes some weekends, there's really not too much time for our assumption to play out and be right. So in my case, what I'm going to end up doing is we're going to trade the July-August contracts. They still have some good volatility skew between the two contract months. We're going to trade the July contracts as our front month. Those have 38 days to go. A little bit further than what I usually like to do. I like to do under 30, but it's a couple days, so we'll kind of still stick with it here. And the August contracts have 73 days to go. So we're going to be buying those a little bit further out. Now, again, the whole idea with doing this calendar spread is just to take advantage of the pricing and time differential between these contract months and hoping that volatility expands. If volatility expands, that will make a greater impact or have a more positive impact on our August position than will the negative impact be on our July position. So again, if volatility expands, trading a long calendar spread, you're going to see a more positive impact on the August position than you will see a negative impact on the July position. You want to capture that differential or that premium. Now, what I usually like to do with these put calendars is trade them a couple strikes out of the money. So again, right now DIA is trading at 180. We're going to trade this, since it's a little bit longer in timeline as well, we're going to trade around the 173 strike for July and August. So if I go into my broker platform and then bring up the 173 strikes for July and then August, what I find is that the price on those is about $130. And it's kind of in the ballpark of what I usually spend, which is about $100. It's not just because I like to spend $100, just because it usually ends up being somewhere around, $80 to $100 for most of the calendar spread trades that we do. But this is a good number. It's 173 is our strike price. So we're going to be selling the July contracts at 173 on the put side, and then buying the same 173 strike in August on the put side. The difference between buying and selling is a additional debit of $130 for each individual contract. What I like about this trade in particular is the fact that the break-even points are very, very close to where the stock is trading right now. We are absolutely trading this directional. We're going to take the contrarian market random, thought process here that maybe the markets go down, maybe are a little bit too calm right now, volatility is a little bit too low. And with that, we're going to trade it negative or lower. And we have a break-even point that's just below where the stock is trading right now at about 179.5. So we just need DIA to move down a little bit anytime in the next 38 days to start making some money. And this is assuming that volatility doesn't expand. If volatility expands with these calendars, the break-even points just widen exponentially. You can think of a calendar as growing out of the ground when volatility expands. It just gets bigger and wider and taller. And so that's really what we want to see. So it starts off short and narrow and small and condensed. And if volatility expands, which there probably should be a good opportunity for volatility to expand, we should see this calendar kind of balloon in size here and give us a good opportunity to make some money. So we're going to get into that trade, pay about $130, and the alert is on its way to members as soon as we get filled.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I hope you guys enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. Again, I really appreciate some comments and feedback on not only show number 50 here at Option Alpha, but all the shows that we've done by heading on over to optionalpha.com/show50, where you can also get all of the mentioned links and additional resources and case studies that we talked about here in the show. Again, that's optionalpha.com/show50. And of course, if you like today's show, if you've enjoyed listening to the podcast, please head on over to iTunes, give us a rating and a review. It's honestly the best way to get the show into the hands of those who need it most, and I would be extremely grateful. Finally, you can get our ultimate strategy guide, which we completely revamped. We talked about this last episode. It's been expanded from 40 pages out to 90 pages, step-by-step guide to picking and choosing the right option strategy for any market setup. You can grab that by going to optionalpha.com/ebook, optionalpha.com/ebook. Until next time, happy trading.